Apple and Microsoft stocks touched all-time high recently, and Disney and Uber reported earnings that surpassed expectations. But also, on 5th August, S&P 500 dropped 3% and Nasdaq 3.7%. More and more Indian investors are enticed by the US market, but are intimidated by the ups and downs. So today, let's sit down to understand the real impact of these crashes, if you should be scared of them, and the most important question: should you even invest in the US market? To begin with, let's go back to 2020. The worst day for Nasdaq over the past 30 years was 16 March 2020, when the market fell by 12.32% in a single day. But within a year, Nasdaq gave a whopping 95% return. In an interview with The Street, Warren Buffett said that if you're worried about corrections, you shouldn't own stocks at all. So, stock market corrections will happen, and as investors, you shouldn't be too afraid of it. They might be a great opportunity to invest more. So now that we understand that corrections are inevitable, what about the drop seen on 5th August? Let's break it down to see what really happened. Warren Buffett sold 56% of Berkshire's Apple stake in 2024. This is likely just a profit booking, as Apple stock was trading at its all-time high, but this news of Warren Buffett selling Apple shares caused investors to panic, rise in unemployment, and disappointing economic report. According to a report published by the Bureau of Labor Statistics, the unemployment rate has gone from 3.7% in Jan 2024 to 4.3% in July 2024. A higher unemployment rate signals a weakening economy and creates market uncertainty. It reduces consumer spending, impacting most businesses and limiting expansion as investors become reluctant to invest in such an environment. This rise in unemployment raises concerns about economic health, diminishes business confidence, and dampens investor sentiment. Interest rate cuts. The Federal Reserve kept interest rates between 5.25 and 5.50%, but markets and economists expected rate cuts starting from September, which isn't really a good sign. While lower rates are intended to boost economic growth, they also signal potential problems, as the Fed typically cuts rates when the economy is weak or facing trouble. This can worry investors about the underlying reasons for the rate cuts and the severity of the economic issues. Carry trade. Carry trade involves borrowing money in a currency with a low interest rate and investing it in another currency with a higher return. Traders had borrowed Japanese yen, which had low or sometimes negative interest rates, and invested the borrowed sum in US stocks and bonds, expecting higher returns. However, Japan has increased its interest rate from 0.1% to 0.25 on 31st July. The exchange rate also fell from 160 to 145, which is almost 10%. This change made borrowing more expensive and reduced the value of US investments. So it's evident that a market drop cannot be attributed to a single event or even a country. Now, considering all of this, let's move on to the last segment of this video. Should you invest in US markets? Investing in the US market has various advantages. First, fractional shares. Fractional shares are portions of a whole share of a company. US markets allow you to buy a fraction of a share, like a half or a quarter, making it easier for you to invest with smaller amounts of money. This gives you access to global giants like the Magnificent Seven and innovative booming sectors like AI and data centers. Second, diversification. Consider three investors: Sonu, Monu, and Nonu. Sonu invests 100% of his equity investments in the Indian market. Monu does the same for US market, and Nonu divides half of his investments into Indian market and the other half into US. Now suppose they all had invested a lump sum of ₹1 lakhs 1 year ago and 5 years ago. This is what the value of their investments would have been in both cases. Sonu and Monu get the most returns in case A and B respectively, and Nonu neither earns the maximum nor the minimum returns but reduces his risks. So there's a higher volatility if you invest in either one of the markets, but lesser risk if you invest in both. This is the benefit of diversification. Now you might think, what about the taxes? The tax rate on LTCG on US investing is the same as the capital gains on investing in the Indian market, that is 12.5%. Third, US dollar appreciation. This is that one additional advantage that investors Monu and Nonu get by investing in the US market. If you have a dollar-based asset such as US stocks in your folio, at least a part of your folio will be unaffected by the depreciation of the Indian rupee. So essentially, investing in the US market helps you diversify your investments, reduce Indian rupee depreciation, and get access to a wider investment avenue. So that's it for this video. We hope you learned something new. Make sure you like and follow, and let us know if you have any questions in the comments. See you in the next one.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.